As I alluded to in the earlier video, it's probably not very likely that an investor holding just one stock is going to earn the return commensurate with its risk. And the reason for that is because they don't have to. If they hold a diversified portfolio of stocks, then they can reduce their risk from just holding the individual stock. So why would the market actually compensate you for risk you don't need to take? So the one stock investor bears higher standalone risk because they're, in many ways, the market thinks they're being stupid. So returns less than that required by the risk, and you're on your own if you're just holding one stock. So how does the market measure risk for individual stocks? That's kind of hard. And at this point, I need to mention that I have tried to teach this in several different ways, because these theories that we're going to throw at you at this point have a nice development, and I love to do that. But whenever I do that in class, I begin looking out in a sea of deer in headlights looks. So rather than try to develop this rationally and logically, let me just throw it at you, because it usually doesn't help most people to develop it rationally and logically. So essentially, here's what I'm saying. Market risk, which is relevant for stocks held in a well-diversified portfolio, is defined as the contribution of a security to the overall riskiness of the portfolio. We're only looking at the stuff, the added risk to a well-diversified portfolio, which we're going to benchmark using what we will call the market. It's sort of like a market basket of every stock that's out there. So if I held the market portfolio, how would it add to that risk or detract from it? So how do I measure that in the first place? Well, it's measured by a stock's beta coefficient. And the person who developed the concept of a beta coefficient was a man by the name of Sharp. He's the one who's credited with it. He kind of did it at about the same time as another researcher named Lintner and another researcher named Mosine. Sharp gets a lot of the credit for it because I think his paper may have actually come out a little before the other two, and Sharp lived long enough then to earn the Nobel Prize when it came out. He was standing on the shoulders of giants such as Harry Markowitz, who did a lot of the groundwork that developed this particular theory, the capital asset pricing model theory. And so essentially here's what we're looking at. Beta, which is a measure of correlation between individual stock and the market, times the standard deviation of the stock divided by the standard deviation of the market. And by the way, if you're a real stats nerd, you'll realize that that beta coefficient looks familiar. It looks like the slope coefficient in a regression model, and you would be absolutely correct. Of course, I really didn't expect anyone to say, oh, that looks familiar. So the capital asset pricing model, again, Sharp won a Nobel Prize for coming up with this back in, I think it was the 80s. Capital asset pricing model shows the return to a particular stock. And when we talk about return, we're not talking about what does happen. We're talking about what is expected to happen based on systematic risk. So the expected or required return for a stock should be a function of only the systematic risk. That's just the risk to the market, the risk I can't get rid of. The unsystematic risk you can get rid of through diversification, so why would I give you return based on that? Capital asset pricing model is used to determine the required rate of return, which is measured by that degree of correlation and that beta equation kind of thing on the earlier slide. And so what we would do to get this, by the way, is we would run a regression model where we get the risk premium, meaning the return, the observed return to the market, minus the return to a risk-free asset. That's my X variable. It's called the risk premium. And I would correlate that, see how highly correlated it is, to the return to this particular stock. And when I run a regression model, it will give me an estimate for that beta coefficient, that beta I. Beta sub I, or in this case I said sub j, is a measure of the stock's sensitivity to market fluctuations. The higher the beta, the higher the sensitivity, the higher the systematic risk. When beta sub j is equal to 1, then the volatility in the market is very close to the volatility in the stock. At least the systematic portion of it is. This only looks at the systematic risk. So, for instance, the stock that I've been using as an example is Rocky Brands. That's the boot company. The beta for this, and by the way, you can find the beta for virtually any stock by just going to google.com/finance, typing in the ticker symbol as I've done here, and right here is the beta estimate that they have come up with. By the way, the homework, if you haven't figured this out yet, is for you to calculate this up yourself, but I'm now showing you that you can later go out and double check and make sure you were right, or at least come close, because this one and Yahoo and MSN Money all estimate beta, and they usually come up with a slightly different number. But in this instance, Rocky Brands' estimate of beta is 1.07. Now 1.07 is incredibly close to 1, meaning that Rocky Brands' systematic risk is very close to the risk to the market portfolio. Again, risk has two components, market and firm-specific risk. The firm-specific risk can be eliminated through diversification. The market risk cannot be. Therefore, you're going to be compensated for only the component of the risk that you can't get rid of, the market component. The greater the systematic risk, the higher the return will be required by the market. So the beta regression coefficient measures the systematic risk, because beta determines how the stock affects the riskiness of a diversified portfolio. Beta is the most relevant measure of a stock's risk. Under the capital asset pricing model, it's the only relevant measure of systematic risk and the only relevant measure of a stock's risk, and therefore it's the only measure of risk that we're going to consider under a capital asset pricing model framework. Now, the nice thing about portfolio betas, and the thing that is very different from the portfolio standard deviations, is if I have the betas of individual stocks, the beta of the portfolio, which is again a measure of risk, is so much easier to calculate, because even if I have the individual standard deviations of individual stocks, it becomes a real mess trying to figure out what the standard deviation of the portfolio is, because I need the correlation coefficient. That's not very helpful. But the betas, on the other hand, are easy, because all I have to do is take a weighted average of them. So if I have the beta of a whole bunch of different stocks, and I know what the proportion that they hold in my portfolio, the W's, then all I have to do is take a weighted average, and I've got the portfolio beta. I'm about ready to shift gears, but before I do, I need to go back and hit one more little concept with this capital asset pricing model. Capital asset pricing model is trying to find the required return to an individual stock, R sub I. And it says that R sub I is equal to a risk-free rate, like a Treasury, U.S. Treasury bill, or a U.S. Treasury bond, depends upon whether it's what kind of a person is actually doing this. I've realized that over time that lots of practitioners like to use longer term instruments than academics. Academics are looking for complete risk-free, which would be a Treasury bill, a very short-term Treasury bill rate, R sub RF. And a lot of practitioners are realizing that there are lots of manipulations that go on from the Federal Reserve and from other sources that make them wonder about that number, and so they don't tend to like to use it. So let me put it this way. Risk-free rate is a Treasury instrument. Whichever one you're using, we're going to use that in the risk premium as well. The risk premium is just the return to the market minus the risk-free rate, however we defined that earlier. Now the return to the market is really forward-looking, and that therein lies the problem. Whenever we've tried to look at this empirically from an egghead's perspective, we've actually gone back and said, what has it been in the past, and I'm assuming that that's what it's going to be in the future. And then we're going to take that risk premium, whatever it is. It's like, here's what the market is assessing for a market portfolio, meaning if we took everything in the market together, how much of a return on average is the market requiring for taking on the risk in general to stocks? That's really what the risk premium is saying. Over and above the Treasury risk-free rate, how much additional risk are we going to expect for the entire market portfolio? And then we're going to multiply that risk premium by a beta coefficient that says there is, in addition to the systematic risk to the market, there is additional risk in holding this particular asset. Then we're going to add that to the risk-free rate and come up with a required return. That's essentially what we're doing with the capital asset pricing model. Now, having reviewed this capital asset pricing model and actually telling you in a little bit more detail exactly what it means, let me now throw a monkey wrench into this, because the capital asset pricing model, essentially, when we derive this thing, the risk premium is the X variable. The R sub I is the Y variable. We're about ready to shift gears, and instead of using the risk premium as the X variable, we're going to use beta as the X variable in a graph. So we're taking the risk, not the risk premium, but the risk, and plotting that against the return. Why? Because that's what this chapter is about, risk and return. It's not risk premium and return, it's risk and return. So with that introduction, let me pop over to the security market line. The security market line is derived from this capital asset pricing model. It's part of the theory, and the big difference here is which variable is the X variable. We're going to be treating the B sub I, the beta sub I, as the X variable. So for instance, if we say, let's assume a risk-free rate of 8%, an expected return to the market of 15%. I don't know why I was stuttering there. I think one of them was supposed to have a hat on it and it lost it. Therefore, the risk premium should be 15% minus 8% or 7%. If that's true, then we end up with this nice little graph. Now again, what this graph is doing is it's graphing the beta on the bottom and the required return, the R sub I, on the y-axis. So beta as x, required return R sub I as Y. Note we are not looking at risk premium for X, we're looking at beta as X. So as beta gets bigger, and again, from the example that I just gave you, we have a risk premium of 7%. So as we go from 0 to 1, we should go up 7%. That's essentially what we're saying. That's the security market line. So first thing we should note is the risk-free rate is that 7%, or is the 8%, excuse me. Wow, that doesn't look like I graphed that the same way. So in this case it looks like it's about 6%, so excuse me because I am on drugs. And then that stock risk premium, as the risk to the asset or the portfolio gets bigger and bigger and bigger from 0 and gets bigger and bigger and bigger, the amount of premium that I'm having to earn as the investor or pay as the company gets bigger and bigger and bigger as well. What happens if there's inflation? Now again, we're going back to the SML. If there is inflation, what should happen to this relationship? That's the question. So in chapter 5, just the last chapter, we said that inflationary expectations are embedded in the interest rate. As inflation goes up, interest rates should go up too. The risk premium, on the other hand, probably won't be affected because the return to the market could be seen as an interest rate, and the return to the risk-free asset is an interest rate, and they should both have inflation embedded in both of them. So we'll take the one that has inflation and would subtract out the other one that has inflationary expectations, and they will just kind of throw one another off, and so, well, nothing's going to happen to it, except when you go back and look at that line, this line is like a y equals mx plus b. Realize that the slope of this line is the risk premium, which I just said didn't change. However, the intercept did, because the intercept is just the risk-free rate. So as inflation goes up, I should shift from SML1 to SML2, and my cost of equity capital, if I'm the company, has now just shifted up all the way across. What happens if the country and the investors become more and more risk averse? What should happen to my cost of capital, my cost of equity as a company, if everybody in the economy becomes more risk averse because they're all retiring, because they see much more risk in the market? First off, realize that if there were no risk aversion, all assets would earn exactly the same return. Therefore, as risk aversion increases, the risk premium, the difference between return to the market, and a risk-free asset, that premium is going to get bigger. Now remember, in the SML, the risk premium is the slope. That should tell you exactly what is going to happen. But first I have to give you a bad joke. Again, it's not funny, but it's not me. So here's what should happen with some risk aversion. We shift from SML1 to SML2 as risk aversion as people become more risk averse. The slope of the SML should change. The risk premium should increase. Next question. What about individual stock risk? What if the company just becomes riskier? What happens to this SML? This one's a trick question, by the way. If a stock becomes less risky or more risky, then the systematic risk will go up or down. So what will happen to the SML? Absolutely nothing. The only thing that will change is the beta. And the beta is just the X variable along the bottom. Doesn't change the actual X axis. It's just that your company moved to a different part of the X. Okay? So with that introduction, let me do one last little thing, and that is I spent a great deal of time talking about the capital asset pricing model. So since the 1970s, actually late 80s, okay, the 1960s when it was proposed, what's happened to the capital asset pricing model? Do people think this is the best thing since sliced bread? I mean, we did give the developers a Nobel Prize, so it's got to be great, right? Everything, we've figured it out, everything. Well, not really. Statistical tests have shown some problems with the verification of the model. First off, it's kind of impossible to completely test, verify, or anything. Investors' required returns are based on future risk, but betas are calculated on historical data, so we can't actually test it directly. And honestly, investors may be concerned with both standalone and market risks, and then people have found that, okay, wait a minute, I'm not just interested in the variance and the mean and the variance of an investment. I'm also interested in whether that probability is even normally distributed, because quite frankly we know from other empirical work that it's not normally distributed. So I can't be just looking at mean and variance. Got to look at other moments about the mean. It makes for a really messy model. So some people were beginning to have some heartburn. One person who had heartburn was a man by the name of Stephen Ross, who proposed an arbitrage pricing theory, the APT, which had more than one input, because in this instance we just have the risk premium and the return. So it's just risk return. What Ross did was he proposed multiple factors. He just called them factors. That's all they were called. He didn't even propose what the factors should be or would be. He just said that there's more than one. And so people went out and they said, yeah, that capital asset pricing model doesn't work as well as we thought it would. And then there would be different people who would come up with a model that worked better. Here are the factors. Then a few years later they'd try those same factors. They didn't seem to work the next few years. So it's like, wow, that didn't help us at all. So the factors were inconsistent. There weren't any factors proposed. And then in the 1990s, Fama and French, two researchers. Fama is with the University of Chicago, and French seems to move around a bit, so I'm not really sure where he's with, what university he's with currently. But Fama, interestingly enough, also won the Nobel Prize in Economics. He won the Nobel Prize in Economics, I think it was in 2013, and he proposed a three-factor model. In many ways, it could fit into Ross's concept of the arbitrage pricing theory, with specific three factors, which seemed to hold for all time periods, although the real problem here is there wasn't a theory that kind of explained why it worked. It seemed to work, but it wasn't clear why it worked. And Fama's model looks like this. The three factors are, there's a general risk factor, which is kind of the same thing as we find in the capital asset pricing model. Then we look at company size, and we look at whether the company stock has traditionally traded at high book-to-market rates or low book-to-market rates. Going back, yes, to financial statement analysis ratios, okay? And then once we figure out all of those things, it seems to fit this format. R sub I minus the risk-free rate should be equal to some intercept term plus B1 times the general risk factor plus B2 times the company size plus B3 times the book to market ratio. And what they found is the A, and here was the real clincher. If this works really well, that A variable should not be statistically different from 0, and it wasn't. And then these should hold over different time periods, and they seemed to. And so we came up with this different model for what's called the three-factor model. What's been interesting since they've proposed this is not many textbooks have done more than just mention it, because it's beginning to have its own issues. And so we'll see where this ends up. I just want you to be aware that the capital asset pricing model has had lots of stones thrown at it because it's not perfect. The three-factor model is also not perfect. Then there are many other proposed models, each of which is also not perfect. However, despite all of that, there is a homework assignment that is associated with this particular unit, and yes, it's on the capital asset pricing model. And I'm going to ask you to do that for the company that you've chosen, and then compare the capital asset pricing model beta to those that are reported on many different sites. The problem with the FAMA French model is getting all of the input data, which isn't as big of a problem now because it's posted typically by French himself. The biggest problem is there's nobody out there who's estimating it on these. I shouldn't say nobody, but these main sources that we're going to use to find our beta don't find these other B1, B2, B3s. So go out there, try to apply this stuff, say what it means to your company, and kind of follow the next two little videos, which are apply.